I think what we'll do is just as people are coming in, obviously we're starting the full content in a few minutes, but I think what we'll do is just quick intros while people are waiting, and we can then get into content in a few minutes. So just quick intros across the guys on the call today. I'm Steve. I head up the high growth team here at Cooper Parry. For those of you who don't know what we do as a team, we look after all the venture-backed portfolio here at CP. We have about 350 scale-ups post-Series A in the portfolio, so we're looking after a lot of businesses running through the venture phase. And increasingly in the last year or two, we've seen more companies obviously maturing into transaction events at the back end of the venture phase, either into private equity or into some form of trade. And so we thought we'd put on this session around vendor diligence, which is something that not everyone has experience with, but it's something we're seeing being used more and more. So that's what today's session is going to be about. Simon is a partner in the transaction services team, does a lot of our work in the vendor diligence space. James is a tax partner in the high growth team and looks after all of our diligence on the tax side and leads the tax team across the high growth segment. So maybe Simon, just do a quick 1 minute intro. James is saying we'll go from there.
Sure. Okay. Thanks, Steve. Hi, everyone. So yes, Simon Nichols, as Steve mentioned, I'm the partner who heads up our transaction services team in Cooper Parry. We do an awful lot alongside Steve and James on core due diligence, both buy side and sell side, at various stages of a company's evolution and value growth story. Particularly over the past year, we have been doing an awful lot on the sell side, and hence the discussion today. And when we talk about sell side, we're doing that across quite a spectrum across the life cycle of the deal, from early stage helping to prepare basic financial information to helping prepare data packs for bidders to a wider due diligence process, which we'll go through in much more detail. So yeah, looking forward to it.
Cool. James?
Hi everyone, James Peck, Head of Tax for Tech and High Growth. Today, I think I'm going to concentrate on the kind of areas, the pitfalls that the companies can face as they kind of potentially gear up for some kind of liquidity event, and therefore when is the right time to start thinking about kind of preparedness, and what are the kind of key areas that you might want to consider. Plus, I think I'm also giving a few reflections on the budget and what that might mean as well in terms of the wider connotations in terms of what happened a few weeks ago.
Cool, absolutely, thank you. Just to give everyone on the call a kind of snapshot of what we're going to cover. I'm just going to quickly flash this slide up, and I'll take it down in a second. But this really just gives you a bit of an idea of what we're looking to run through in the next 45 minutes. Quick bit on background and market conditions and what we're seeing from in the deal space, particularly in the high growth venture PE space. Then a bit on buyer universe and just looking at kind of the differences we see between fundraising processes and full exit processes, and EU, US trade, financial, and how we see the differences playing out. A little bit on Simon's reflections on his experience of seeing the readiness of companies moving into this phase, into a transaction phase, and what he sees as those areas as to how you should be ready in sort of 18, 12, 6 months out from a transaction. Then we get into the meat of the sort of pros and cons of vendor diligence and really what it means, why it can be a good thing, why it can be in some instances not the right option, why there are other options that we also use or other people use to prepare for transactions, and then a bit on the tax landscape as well in this space and readiness from a VDD and DD point of view. So that's what we're going to cover. I will take that down, and Simon will start with you on just a question on, I guess, the background, market conditions, and how you're seeing deals at the moment. And then James, I'll come to you on the budget.
Sure. Okay. Thanks, Steve. So quite a meaty topic to start with, so I'll try and keep it brief because we could talk forever about market conditions. I think it's fair to say choppy is probably a summary. There's obviously, if you step back from a macro perspective, huge geopolitical uncertainty, general economic uncertainty. What does that mean if you boil it down into the deal world? There's some still quite stubborn inflationary pressures. Inflation's not coming down as quickly as we hoped, and then hence interest rates the same. I think from a deals perspective, we're seeing that still means debt's too expensive. So a number of that's obviously slowing down things. I think the other thing is the valuations have softened since the pandemic years. If you think about there was some huge amount of deal activity, 21, 22. That's slowed down, and also valuations have come off a bit. And I think there is still a bit of a buyer-seller mismatch around price expectations as a hangover from those toppy heady days. And so that basically means that we've been finding over the past year or so, deals are taking much longer to complete. So what would take, I don't know, 6 months is now 9 to 12 months. Deals are falling over more as well because there's to that point of this buyer-seller mismatch. But having said all that, I'd said there's some cautious optimism. If you look at the numbers, I mean, number of deals are down over the past year, but actually in the past 3 or 4 months, and I'm sure part of this is budget driven as well, and people trying to get things done pre any CGT changes, but we've certainly seen an uptick. We're much busier than we were ourselves. We're seeing other people in the same position. I think if you look at the sector, I think TMT is the right sector to be in. I mean, it in the mid-market, about 25% of all deals in the UK were in the TMT sector so far this year. So, there are sector focuses, ones that are resilient to those macroeconomic challenges like tech, healthcare, energy transition. We're seeing a lot more there. And we're seeing the size of deals starting to tick up as well. So I think that it's an interesting time. I think if you've got a very strong value proposition and you've got a fundamentally good business, it's still a great time to be doing deals. James, obviously there has been a push around the budget, so I don't know if you wanted to just briefly reflect on that.
Of course. So I think the budget has taken us by surprise in some regards, and others not so much. I think my initial observation is that there was a lot of kind of build up to the budget in terms of the concerns that there was going to be an alignment to kind of income tax and CGT rates, right? And a lot of observations, a lot of concerns in relation to whether, if that would happen and the wider implications on that in terms of driving entrepreneurship for a lot of tech companies, but the wider economy as a whole. Bottom line, we ended up in a position where they increased CGT by 4% up to 24%, effective immediately. And we know that business asset disposable, let's call it old ER, entrepreneurs relief, is going to increase up to 14% from April next year, and then 18% thereafter. I think if we read between the lines here, when I look at the budget, the overarching view that Reeves was talking about was closing the 22 billion deficit that had been created. And in many ways, that became kind of the reason and the rationale for quite a lot of the discussions around the kind of increases in taxes. And yeah, I know we only mentioned CGT, but there was the increases in NIC, the changes to IHT, and a plethora of other kind of tax changes that are going to come down the line. The whole point here that I'm going to make is that my initial observation is that CGT had increased already, and I think that was an anomaly. It was quite strange to increase CGT in year. And I guess the inference there was that it didn't leave a huge amount of time for planning. Right? I think we all expected CGT to increase, but we were expecting it to be in April, and that gave a kind of window where people could do transactions prior to it changing in April. But the immediate increase, obviously, was slightly, quite a surprise. My take on this, though, is that given that business asset disposal is eking up and that we've gone to 24% on CGT, I don't think that this will be the only increase to CGT that we'll see in the next 2 to 3 years. And I think that'll increase steadily over time. And therefore, that will have an impact, I think, as shareholders, founders really start to consider what their personal tax position is. And obviously, there'll be more to follow. This is just an initial view at the moment. But on a positive note, there were no changes to kind of EIS or VCT or SEIS. So, for savvy investors, there are still great opportunities there. And the other point that needs to be addressed from the budget was obviously the potential increase on the taxes for carried interest and the impact that will have potentially on VC. So there are conversations at the moment, specifically from a lot of founders, shareholder perspective, which is all about, are we going to leave the UK? And that's such an open question. I'm not even going to kind of address it now, because are we going to leave the UK? Does that mean the shareholders? Does that mean the companies? Does it mean, the investors? But I'll park that for now. But I think that's going to have a wider implication as we see potential changes unfolding into the future, more speculation, and therefore what that might mean for deals as well.
Simon, just one follow-on question to some of the points you were making on, I guess, types of companies you're seeing in deals at the moment. Obviously, a lot of the venture stage companies are running high cash burn models and have been for years, but there's been a big shift since kind of 2022 valuation reset to those companies getting pushed by their investors to move to a profitable position and start to position themselves to actually ultimately become ready for a transaction that doesn't involve burning cash. So are you seeing transactions where companies are still able to get deals away where profitability is not necessarily the key metric, or is that still ultimately not really an option at the moment for in the M&A space?
Yeah, no. So the answer is yes. I think it comes back to the quality of the business and crucially, I sort of hate this phrase, but the pathway to profitability. I think you need to have a very clear and relatively short-term pathway to doing that. And obviously going back over a year or two, showing a nice smooth growth pattern. Part of the things we'll get onto in the exit readiness thing is around understanding, are there items where you can actually present a run rate business now? If you take the type of companies we're talking about here, you talk about ARR, can you actually make some potential adjustments to baking things that have happened recently to annualize those, etc., etc., so you can actually demonstrate the business now is very different to the way the business was even 6 months ago. And in these types of businesses, a month or two can make a massive difference.
Yeah.
I think the key to me in a summary is you need to. You're absolutely able to do that, but you need to have started the journey and have a very credible argument of how you're going to continue that.
Yeah, and then picking the right point in where you are in that cycle and that path to profitability, right, to get the transaction away.
There's always, if you think of sort of scales on every deal, regardless of sector, there's always that thing around value versus timing. And I think you need to weigh that up in your personal journey of where if you're an OMB, it's very different to something else and where you are personally as well. But there's always those two tensions.
Yeah. Okay, just moving into second part of the session around buyer universe. And at the start there, I was talking about fundraising versus exit processes as kind of the starting point of that, because a lot of people in the call will be very used to raising rounds and raising money from investors, but maybe less people in the call would have been through a full exit process. So just useful to get your perspective on how you see the differences ultimately between a fundraise event and an exit event.
Yeah, sure. So I'd say, again, trying to keep this relatively brief and high level. I think the key thing here is obviously on a sale, you are generally relinquishing control. So, not always, but generally relinquishing control. And I think obviously you need to think about that both from a financial perspective, but also from a business stroke emotional perspective as well, because it is very different depending who you're selling to. Timing's the other key thing. I would say, again, I'm generalizing here, but obviously a sale process will generally take a lot longer. There's more moving parts to it. There are more external advisors, parties, etc., etc. So typically, as I said earlier, we're seeing deals on a full sale are taking up to 12 months sometimes, 9 months probably typical. I think the focus as well, on a sale, you're dealing with things where you are trying to value a business. You're also thinking about potential earnouts, how you keep people involved in the business. You're also thinking about the legal side of it and warranties and indemnities. And we'll come on in a minute to like the type of buyer, because I think if you're selling to a strategic versus a financial, there are quite different requirements as well. So that's probably the summary. I don't know if you want me to go into the type of buyers now.
No, well, I think, let's cover that in a second. Just before we do, James, just in terms of your perspective, obviously having taken several companies through fundraising events and full exit transactions and IPOs. Just useful to hear your perspective on how or where you see the differences ultimately in there, because from particularly on the topic of ultimately on the topic of DD and preparedness.
I guess it fundamentally boils down to a couple of things, which is what stage are you at, right? So there are different inflections, but then there's always going to be anomalies in relation to this. So there is always going to be a lighter touch when a company's doing a Series A, right? Let's just be honest. Most of the time, you can probably get away with doing quite a high-level review and ensure that the main areas that you'd expect to be covered have been at least looked at and reflected on, right? But that's not always going to be the case, right? We've seen so many instances where people are throwing the kitchen sink at a Series A and it just comes out of nowhere. By the time you get to a Series B, Series C, I think, yes, you probably need to think about the level of preparedness that you're doing in advance, making sure that you're doing risk assessments, working with someone that actually understands the profile of a transaction, and basically can take you through where they think the anomalies, where the tax areas will be. I'll cover some of those later, right? And fundamentally, that's how we work with our client base, is we use that knowledge and understanding of like later stage transactions and then bring them into clients at an earlier stage. So really getting them deal ready right from the get-go, right? So using that, you're always going to be aware that I would expect at a Series B, there's probably going to be further risks that need to be mitigated. And actually having an awareness of that gives you kind of, walking into a transaction, you kind of don't want to walk into a transaction blind. You get blindsided then during the diligence. And if you're doing other forms of diligence, be that the VDD, be that the legal DD, the tax DD, the people DD, what you want to do is take off the table the areas that are potentially highly sensitive and can actually make deals fall over. So I do a lot of diligences at that kind of Series A, B, C stage, loads of, and actually there have been multiple deals that have fallen over because of things that we've identified, and therefore the deal just hasn't continued at that point. If we get into exit, it's going to be another round of diligence that's going to be much more scrutiny in terms of the business, as it would do for an IPO. So the questions are a lot more in depth. They're a lot more, you're covering a lot of ground and really identifying the key sensitivities to ensure that there's nothing lurking in the background that's basically going to come back and bite at a later stage. So I think evaluate the stage of the business, where you are, if it's a fundraise, how much are the expectations, and then if it's an exit, there's probably going to be more work needed. Now, this is a rule of thumb because I've just kind of worked with a company that's just done a Series C for quite a sizable check, and that was from a US investor. They didn't do any tax diligence, like nothing, right?
Yeah.
And there were a whole load of things that I've kind of identified that were issues, but they just didn't. They did FDD analysis, but no one thought actually we'll hire. Like the US team didn't think to hire anyone in order to do a tax review of the business, and there's a load of risk in the business. So yeah, working with those guys now to kind of rectify those. Again, I've also seen stuff where you've got US teams who have appointed US tax advisors who don't understand UK tax. Useless, absolutely useless. So I think look, there's no kind of rule here, but I think the more that you can prepare, then you will then face all the eventualities. But it's also good to know where the risks in your business are, because then at that point you can then kind of work with those. So my main bit is don't be blindsided as you walk into a transaction of any size.
Yeah, Simon, just on that UK US piece, we tend to think that the US VCs, we generally do see lighter weight diligence on fundraising, but suspect at the exit end of the market it might be the other way around. So what's your perspective on that?
The opposite, yeah. So again, we're generalizing hugely here, and there are honorable exceptions, but I would say that if you step back, the US market is not nearly as familiar with the vendor due diligence concept on a full exit. And the key nub of this is, doing vendor due diligence, the duty of care passes to the purchaser. The purchaser, the bidder, the eventual purchaser can rely on this VDD report as if it was effectively done for them. So they don't need to do a huge amount of additional top-up buy-side diligence. That's one of the beauties of it. But the US doesn't get that. And so you still find I'm doing 2 live deals now where, when we do our VDD report on sell side, we then have bidder meetings where they will have their advisors. We've got PwC working on the other side on this one. And they come in and they try and redo the diligence themselves, and you need to sort of manage that expectation. You don't need to do as much of this. And also the focus is more, I find, on sort of audit type procedures, ticking everything back to trial balances, all that sort of things. A huge amount of scrutiny often around, are these audited numbers? And the point is they don't need to be audited numbers. In fact, they probably shouldn't be, because they should be reflective of the business now to allow you to value the business now. And as long as you can anchor that back to audited numbers and reconcile that back, that's all okay. So in summary, I think we need to, and part of this is within our gift, is to continue to explain the differences and make sure at the start of a transaction, or again, 12 months in advance, if you're thinking of going to the US market or indeed any other markets, you fully understand the buyer universe there and therefore their expectations. Because right or wrong, you're going to have to prepare for it.
Yeah, understood. Just on that, coming into the next question I had on the original slide, I'll bring that up in a second. Just in terms of assessing that period between 18 months out, 12 months out, 6 months out, I'm interested in hearing your perspective on those various inflection points, and also maybe any examples you've got of businesses that maybe have or haven't been at the right place at those points in time, and what that did to the deal ultimately as well.
Yeah, sure. So I think the key here is, the key message is, it's never too early to start thinking about this. I think if you are even considering it, well, it should be part of the overall board discussion anyway, I think, around, what is the plan longer term, and, what is the time horizon to achieve that. I would say, 2 years is a good time to start thinking about if you're having any plan for any sort of exit or sale or event, that you should start thinking about that. And what do I mean by that? I guess this is just at a high level. I would imagine that yourselves and the board should be thinking about, are we thinking about the value proposition of the business? What is the sort of USP of this business? And if we were to look at it through the eyes of an aggressive type purchaser, if we take that exit route as an example, what are the areas they'll want to get reassurance over, and what are the key areas they'll want to pick on? So, for example, have you got a very strong recurring revenue base? Have you obviously got that key growth story which you can show? Have you got a management team that's fully equipped for the next stage of growth? Is there a succession plan in place? What are the plans over that? And as I've mentioned previously, what's your sort of buyer population? Are you thinking mostly about financial or strategic or something else? And depending on that will depend on the next stage, which is about 12 months out, thinking about how you then cut your cloth accordingly. The only other thing I'd say, just high level on that early stage, is, I would say this, but I think it's very important to have a good M&A advisor on board to help challenge you on those initial questions as early as possible. This doesn't need to be a big exercise, but I think being able to bounce those sort of things off people who have done hundreds of deals and can bring some of that deal craft to it, sector specific, is super important.
And that ultimately, that I think we spend time at companies talking about this stuff well in advance of an actual transaction event. So in terms of like a more formal readiness type assessment, is that something you see in the market? Is that something people are using to then create an actual kind of written plan, if you like, in the run up to?
I think once you've sort of got answers to those higher level questions, when you're about a year out, it's time to think about, okay, actually we now need to potentially do something about this. So what we offer a specific readiness assessment diagnostic, as do others, or indeed companies could do this themselves, to be honest, as well. So the initial thing I'd say here is for example, you want to go and have a look and do some sort of initial traffic light report or something across some key areas about, are we ready? And those key areas would be things like, are the financials robust? Have you got a decent forecast model, for example? If you look at your historic track record, does it track up smoothly the way you would want or not? What are your quality of earnings? To some of those points I previously mentioned, recurring versus one-off revenues, strong secured pipeline, those sorts of things. Have you got the right corporate governance structures in place for the next stage of the journey? What's your growth story? what are the threats to that growth story from a sort of market competition, and very importantly, on the legal and tax side, is the legal structure simple and fit for purpose going forward? And on the tax side, are there any big ticket tax exposures that you need a bit of time to sort out? James, I don't know if you want to give any specifics there.
Yeah, absolutely. So I think let's touch on that first point, which is the kind of pre-transaction steps you talked about. So if you're, look at the group as it stands at the moment, and then effectively, are you selling the whole entire group? Are you going to sell elements of it? Are you going to roll stuff forward? So take the time, and it will, take the time to analyze the group as it stands at the moment and work out, actually, am I selling everything, or do I need to break that down into composite parts? It's, if you are breaking things down, either through a reorganization, through a restructure, we'll refer to it as a demerger, these can't be rushed, right? They take time. And therefore they are complex, and it will take time from both a tax and from a legal perspective to kind of get your ducks in a row. The other thing obviously to think about as well is kind of shareholder planning, both for any kind of existing shareholders, to understand what the kind of roadmap is going to be for those. Now, depending on the business, that might have different profiles. So given what I said about the budget, some shareholders, if they've got majority shareholdings in businesses, they may want to start thinking about potentially offshoring themselves prior to a liquidity event, right? Or, if there's going to be a sizable secondary transaction, does that align to what their requirements are and where they're going to be? So think about the shareholders, start speaking to those key stakeholders, especially if they're the founders in the business. I think those need to be considered. The other thing to think about as well, just because we'll come onto this point specifically, but getting your ducks in a row from a share option perspective, right? Actually, what have you got in place at the moment? Is it fit for purpose? The number of times that we've unfortunately seen share option plans fall apart as part of a diligence, and that's going to be something that's going to be scrutinized. We see them, and there have been a number of instances where EMI schemes, CSOP schemes, growth share schemes, we've looked at those in detail as part of a diligence, because actually we're trying to assess, are they qualifying schemes? Are the individuals qualifying individuals, qualifying employees, qualifying companies? If as part of the diligence you find out that your share option plan hasn't worked out, right, you're in a really challenged position at that point, because you're already in a deal consideration. So therefore, you're not going to be able to get discounts against market value and things like that. Now, I am going to say this. Unfortunately, we see this go wrong on too many transactions, on too many diligences. We start to pick at the EMI schemes that have historically been put in place, and unfortunately, there's a lot of errors that have been done. And I think there's a number of reasons why that is the case. I think there's a lot of people relying on automated platforms without huge amounts of human interaction to kind of implement their EMI schemes, right? And frankly, that is a large no-no. The other thing that I see also is that people will use or consider that an EMI implementation scheme is simple, right? It's easy to do. So therefore, what we'll do is we'll roll forward what we've done in the past, use the same legal documents and all the rest of it. Again, that's where you see issues happening. We see issues where people haven't issued EMI options, they've issued promises, and then they forget further down the line, or there's a further valuation that can increase, the strike price. So there's a number of issues that we see. So I think making sure that you've got clear line of sight in terms of setting up and implementing share option plans. The other thing is, let's go back to the budget for a moment. If you put an EMI scheme in at the moment, and the scheme qualifies, if you've held your share options for 2 years prior to an exit, you'll then still be able to get the lower rate of tax at business asset disposal relief. So 10% at the moment, going up to 14, going up to 18%. I won't get into some of the horror stories that we've seen in the past, but there is a whole raft of reasons why share option plans can fall apart. So yeah, pre-plan, think about what the group structure looks like, think about what the potential founders are doing, especially if they have majority stakes, think about the share option plans as well. There are other things to look at. I think generally speaking, assess the business. Are there areas that are going to be likely high risk for you in terms of, do you have international footprint? Are you heavily claiming on R&D claims? We know that that's an issue at the moment as well. I'll touch on some of these later. But assess the key risks and the wide implications those will have in terms of what indemnities, warranties, price or value ships. Yeah. I think they're the kind of key areas.
Yes, Simon, just on one, I want to get into the meat of the VDD.
Can I just say, Steve, on that? Because we've thrown a lot of stuff out there, right?
Yeah.
can be a bit overwhelming, but actually, this doesn't need a complicated, long process. When I talk about this diagnostic, we're talking about going in, having some discussions with management when we do it, and it's a week, and we produce a sort of traffic light report from that in each of those areas I've covered: red, amber, green.
Yeah.
Are you ready or not? Which gives you the focus, obviously, on the red ones to give a bit of time to do these sort of things that James has talked about.
Can I just ask one final question on this area? Because venture-backed companies are used to running detailed financial models. They're used to fundraising events. They're used to a lot of rigor that OMB businesses generally aren't. And I guess the final question in this space for me, if you've got an example, Simon, is when you've seen venture-backed companies coming into the process, where do you see the weaknesses in their readiness as opposed to OMB space, which I think are probably a bit more wide-ranging, but in a venture-backed business in particular, where do you see the stuff that comes out that these companies are just not as ready as we would expect them to be?
Yeah, I think it's just, to be honest, it's around, depending on where you're going in terms of buyer universe again, because I think if you're thinking of going down the financial route, and private equity as an example, but others as well. I mean, they do a lot of diligence, right? And they're not going to fully understand always the business model. They're not a competitor. They're sometimes sector agnostic. So I think sometimes you get that. It's a harder thing to describe, but you get that more intangible thing where you've got somebody who lives and breathes a business versus the buyer who's a bit more hard-nosed financially and doesn't really care about the emotional story.
Cold numbers on the page.
And actually, they're thinking about it from a, how are we going to leverage this up potentially? How are we going to, look at operational efficiencies, cost savings, things like that. So you've got to be ready, I think, for that sort of emotional challenge to how can we, I might not know your business, but I need to improve the ROI and I want to spin it in 3 to 7 years. So, how does that work? If you're going down the trade side, I think that we're also I'm seeing this where with strategic or competitors around, have you thought enough about, the underlying business might be fabulous. Have you thought enough about revenue and cost synergies going forward as you're absorbed potentially into a bigger group or something like that? How's that going to work in terms of management and decision making? So I'd say in summary, it's those more qualitative factors that you need to think about early, because it's so important. We can talk to death about the numbers. If the cultural alignment doesn't work, that's where most deals fall over.
Yeah. Cool. Thanks. Okay. Just on the VDD point now, I think it's just a reset on everyone's understanding of what VDD actually is and what the purpose of it is. I think you touched on it a bit earlier, but just to talk about the timing of when it takes place, who engages who, where the risk sits, where the reports go, like what's the whole point of this whole topic we're talking about in terms of VDD?
Yeah, sure. And I'm going to try and summarize this because I could talk forever. So I think let's start with some common themes around. So the sell side areas we tend to focus on fall into two buckets. So I'm going to cover both of those. So that we'd have vendor due diligence, full due diligence type report, but also what I would bucket as vendor assist, and that's a sort of slightly earlier stage process. But I'll talk about them both separately. But they've got common themes. If you sort of step back, what are we trying to do here? It's linked to these points we've been talking about so far, which what you as a seller and what we are there to help with is around accelerating the process, minimizing the disruption through a process to management, and ensuring that vendors are sort of on the front foot and controlling the process, rather than we often see purchasers on the front foot, and that's not a great place to be when you start, and it generally gets worse. So vendor due diligence, let's start there. So that is basically where you will have, and this will encompass lots of different work streams. We obviously tend to focus on the financial and tax due diligence. Normally on a deal you'd have legal due diligence, commercial due diligence, technical due diligence, obviously in this space is crucially important as well, operational, etc., etc. So you've got a whole bunch of different things going on. Generally the ringmaster in that will be some sort of M&A investment banker who's controlling the overall process. And you can already imagine, I can see some horrible thoughts of all these advisors all around, so it needs careful control. Due diligence, vendor due diligence is where we are producing a we're doing a full due diligence exercise on the business, and we are crucially independent of the seller. So we are going in effectively to provide the bidder with an independent and robust challenge on the business. And as I mentioned earlier, crucially, whilst we initially engage with the seller to agree the scope, um, we will then, when the eventual purchaser does the deal, our duty of care flips to the purchaser and they can rely on our report. So that's crucial. As I said before, that should allow purchasers to do very minimal top-up diligence because they can rely on all the diligence that we've already done, which will be a full scope financial and tax due diligence. I think the key other things to think about from a VDD perspective. So typically, this will be I'm generalizing, but a sort of 6 to 8 week initial process where we'll go in, we'll have a typical scope of work where we'll be really kicking the tires hard in terms of historical track record, in terms of forecasts for the next 2 or 3 years, usually challenging the key assumptions there and comparing that to the historics, looking very hard at the quality of earnings, the underlying EBITDA of the business, also looking at the balance sheet with a focus on what's the debt and debt-like items, what's the working capital trends, all the things a purchaser would typically look at. So that will flag any sort of issues that they will want to focus on. I think the beauty of it, where it works really well, is when you are in a competitive auction process. So you've got multiple bidders, this allows you to give all of them one report, which will get them, I don't know, 80% there in their diligence. They might do a little bit of top up because obviously there'll be some specifics and idiosyncrasies of their business, but it will significantly reduce the additional diligence they'll do. What does that mean? It means instead of having, I don't know, 8 parties hassling a finance team, you've got us doing it once and then a few top up questions. And on those top up questions, crucially, we'll be sat alongside the seller, batting back, fielding some of those questions, helping sellers through that process as well. And indeed, we'll sit down and talk through our report with them to make sure that there's added credibility there.
You said we're working independently, but we're engaged by the seller. Initially, right?
Correct.
During that process, if there are issues that are coming out in the diligence, what's the situation in terms of fixing them and reporting on them versus cleaning them up before you report? Like how much time is there and collaboration is there on actually presenting a final output which shows no issues, as opposed to we found a load of issues in vendor DD and they get reported to a buyer? Like how does that loop work?
So I think there's a couple of things there. We'll come to that. Really depends on this whole topic we're discussing, the state of readiness of the seller before we start VDD. So I talked about vendor assist. I'll come on to that in a minute, but that would be an earlier stage thing where we can help iron out some of those things before we get to the VDD process. Bottom line is when we get to VDD, the numbers are the numbers, right? And we have to report what we see. We can't start to hide away issues or anything like that. What it can do is it will at least flag, albeit a bit late. Let's say for example, we find in a typical tech business, one of the key things is recognition of deferred revenue on the balance sheet, right? And if I'm an aggressive bidder, I'm going to try and put that in debt so I get a full price reduction for that. If I'm on the sell side, I'm going to try and argue that's working capital and then knock it off the price. Right. If we independently truly believe, there are nuances here, but just keep it simple. If we independently believe when we're doing the VDD it's debt, we're going to have to stick it in debt, right? And that's it. At least it allows you, what we would then do, I talk about that sort of 6 to 8 week process, we'd get a draft report out by week 4. We then have to go through, and are very happy to go through, a factual accuracy process with the seller management to take their comments. But that's the point, it's factual, it's not around can we change this, can we change that. It at least allows the sellers to appreciate that bidders going to focus on that, so they manage the message, can they do something.
The optics then can start to be managed.
Correct. But if you touch, I mean, maybe that segues us nicely into the vendor assist piece, which is if what we're doing there, let's be very clear, this is earlier stage, so we are then engaging directly with the seller. We have no obligation to the purchaser, so we're basically working collaboratively with the seller to help prepare the numbers to prepare them and present the business in the best possible light. So it's a very different thing. This is
can that then go on to become a formal VDD subsequent to the VA work?
It can. What we can do there is, if you do a vendor assist piece, and the output of that, just to be clear, is we would generally produce a comprehensive Excel financial data pack, which can be dropped into a data room, which presents the sale numbers of the business for bidders to review. So and that will be a very detailed pack with commentary. It's not just numbers, so it'll have some high level like analytical review type commentary. What can then be done is, if we think we are going to that big competitive auction, lots of bidders, blah blah blah, that can then be converted into a full scope VDD report. Crucially, it needs a separate team of advisors at the senior level to do that, but we often do that. And you can there are some efficiencies around, rather than doing the two separately, obviously, for taking the base numbers and adding on more of the recommendations and conclusions and analysis on a VDD. On the VA, I'll just say briefly, this is typically a sort of a shorter process, a sort of, I don't know, 4 to 5 week process. You're doing it earlier. So if we talk about that deal timeline, I'll give you an example. We're working on one now where they're looking to conclude the deal by April. If we were doing VDD on that, we probably wouldn't start that till like January. The vendor assist started last month. So you're sort of starting that about 6 months in advance. Crucially, the key there is we are producing those numbers for two key reasons. Number one, you'll be producing a teaser or an information memo or whatever at that early stage. It's absolutely critical that any financial numbers you put into that IM are set in stone and don't move, and present the business in the best light. So again, we're doing those in this space at the moment, where you want to quote an ARR, a number, or whatever, or an underlying EBITDA rather than the historic EBITDA, which, as we talked about before, bakes in some of these run rate adjustments, strips out some of the one-off costs that you've incurred that are not relevant going forward, so presents the business in the best light. So we've got to do this VA now so that the IM goes out and those numbers don't move. If those numbers move at all, you start to lose credibility. If you start to lose credibility, bidders start chipping at the price, because you can see the value dripping away. So that's a sort of nice 4 or 5 week process, working collaboratively, and it flushes out these types of issues that you talked about, which then, way before any information goes to a bidder, it gives management a bit more time to either fix it, or if you can't fix it, at least think about how you manage the message through the management presentations, or start to do something. I think the key with a lot of this stuff is, I see it so many times, you're in these presentations and people say, we've got all these plans for synergies, or we're going to do this, or we've got operational improvements. As a buyer, I'm going to ascribe zero value to that. But if you can instead tell me, we thought about this 6 months ago, we started doing X, Y, and Z, we plan to continue to do A, B, and C, I'm going to give you some value for that.
Yeah, it's already baked in some of the forecast and then the value, right? So in terms of look, I think when you think about the opposite of a VDD exercise, let's assume you haven't done VDD and you've suddenly gone to market. Maybe you've done some prep with an advisor, but you've gone to market. The opposite is you've got 2, 3, 4 DD providers coming at you with effectively at the same time, massively increasing the risk in the transaction, right? So
also just not about not comparing apples with apples. I think the beauty of the VDD product is, you put some numbers out there, and immediately, I see this when I'm on the buy side. If I get a VDD report, number one is I've already, whether this is true or not, right? There's some credibility. They've been through a process. So there's that intangible. Okay, that's a good start. That's a good starting position. I think number two is there's always this beautiful optic of being on the front foot in deals now, and it's the same with anything. Like, if I put something forward to you, you probably won't accept it all, but you'll start to tinker around the edges and chip around the edges. So I'll sort of be on the front foot there. Whereas if I just say, just bring on your bids, there are different assumptions. People have made the wrong assumptions about things. It's really hard to compare the quality of the bids to make sure everyone's on the same apples with apples point.
Are there any downsides to VDD? I mean, obviously, there's an element of investment, because you're ultimately committing to the DD cost in advance of even getting into market. So, like, are there any downsides, or is there anything to mitigate risk in there in terms of just overinvestment and then kind of getting yourself into a position that was maybe where you've gone a little bit too far ahead in the transaction timeline?
I think it's around phasing it. So if you take that, I would say, as we talked about before, always get that diagnostic done 12 months before, because that will then, you don't want to do unnecessary work. Absolutely. So, I've never seen this, but if one of those comes out with everything green, all good, maybe you don't need any of this and you're perfect business. I've never seen that in 20 years of doing this, right? But it's crucial that you do agree the scope so it is a focused piece of work. I would tend to use the analogy where it's like you want to pick 2 or 3 key areas and go deep on those rather than shallow across a whole bunch of stuff. So make sure that you're working with people that understand the sector and can bring that deal craft experience to the exercise. Cost, let's be frank, cost is a thing, right? And VDD is a much more expensive product, if you want, than vendor assist. Partly because it takes longer. Also, you're managing process with bidders, you're batting back Q&A. So whilst I say 6 to 8 weeks, it can be over a longer period. So I think I would say you've got to think hard about things like number of bidders, type of bidder. Private equity would always expect VDD, strategics maybe less so. So linking back to those previous points about understand your buyer universe, so cut your cloth accordingly on that. Having said that, last thing on that, couple of things. Vendor assist, cheaper, it's quicker. It gives you the option to still flip to VDD. And even VDD itself, whilst it's expensive, I think you've got to think about 2 things on that, right? Is it expensive in the context of the value of a deal and these sort of often massive lifetime events, right? Where we're doing things where we are finding points which can, subject to your commercial negotiation, allow you to drive out an extra 5-10 million of value, right? So think of it in that context. And the last thing is we're seeing more and more precedents in the market where sellers are passing on some of the cost of VDD to purchasers. If you've got a great business with a strong competitive auction, we're seeing, let's split the cost of VDD 50-50 or even pushing all of it onto the purchaser because the argument is they have to spend much less on their own top-up diligence.
Yeah, makes sense. Just in terms of timing of getting a VDD report kind of into market, you mentioned kind of a 8-week process roughly. I know there are instances where the financial position of the company can also shift in the middle of a transaction. So I'm just interested in any kind of experience of situations where you've entered into a diligence exercise, but then actually the trending in certain parts of the business is moving, and then you've got to look at what's the actual date at which the VDD is being done to, and is there a better date that transpires, etc. So again, presumably there's an element of, again, the prep before the VDD, which is to assess the trends collectively and start to actually pinpoint when is the best point to fall the VDD on. But what's your thoughts on that area?
There's you've got to call that inflection point of max. When's the point where you're far enough down that growth story? But you can justify the future value of the business in the future growth. What we tend to do, and especially it's very pertinent in this space where month on month, you can be moving rapidly up that ARR curve, or even that point from loss making to profit making. I think the key is, again, make sure at an early stage you're discussing this with a good M&A house who really understand the sector, really understand the buyers that you're going to and what they're going to be challenging, number one. I think number two, more practically, you've got to anchor it somewhere. You don't want to keep chasing your tail. So I think, pick a good period that shows that last 18-month track record. If you do the initial diagnostic and it's showing that your working capital's up and down, volatile all over the place, maybe give it another 3 or 4 months so you can manage that, so build that into the timetable and then stick to it. So let's say, picking, for example, you go on I don't know, December 24 number. But these processes, I said, take a long time. What we tend to find, particularly in this space and this sector, is we'll do that. We'll produce the initial VDD report, and then we'll go and do a quick current trading update addendum, which will be, I don't know, a quarter down the line or 3 months. Rather than, you don't want to keep doing month on month, but let's say on that example, we do that in December. We're expecting to get the deal away by, I don't know, May. Then at the end of March, let's do a quick exercise where you produce an addendum, 3 or 4 pages on current trading, impact on current year outturn, and you give that to bidders then as well.
Right, got it. Makes sense.
I think just the last thing, Steve, I've talked a lot about issues and risks, and I know James has as well from the tax perspective. We shouldn't overlook that this is an exercise where if you've got some great upsides, then we can absolutely challenge and report on those as well, which again can give some good independent corroboration of those which bidders like. So some of the points I touched on before, like if there are operational improvements which you think you can push through, if there are potential synergies with a potential bidder that you can put through, if there are run rate adjustments. And on the tax side, we're seeing a lot in this space. If you've got tax losses, historic tax losses or R&D tax credits, should you ask a bidder to pay some value for some of those?
Yeah. Just conscious of time. If anyone's got questions, if you can drop them in the chat, I'll leave a few minutes at the end for questions to cover. But if you could drop them in now, then I can start to weave them in the next 5-10 minutes. James, just want to cover a few elements on the tax areas and specifically thinking about VDD from a tax point of view. Whether this is something that you see frequently used. Obviously, if there's VDD on the financial diligence side, typically you might see it on the tax side. But what's your perspective on VDD and tax? And also, I do have a question for you that's coming on the chat, which I do need you to cover. So leave some room for that as well.
All right, so I'll be as quick as I can. I think, if you're doing FDD or VDD prior to a transaction, it would make sense in order to do the tax diligence at the same time. Again, just that preparedness, making sure that you've got bases covered, identify the key risks for the business. So that, again, it's that point. Like, unfortunately, I genuinely hate it. Like, a diligence's job is to identify key risks in a business on behalf of the acquirer. And it is, it's challenging at times. Like it's actually, finding issues in those businesses and seeing deals fall over is not a nice situation for anyone to be in. We do see that, unfortunately, a lot. It's just if you can get yourself, if the acquirer can then get themselves comfortable with the ramifications of what the outcome of that might be. Unfortunately, I'm just going to be honest, there have been a number of deals that I've worked on more frequently than I'd like that basically haven't gone to exit or haven't even gone to fundraise because we found things that haven't been considered. And let's just be honest, when we're talking to most CFOs generally turn around to us and say, look, I've got an idea of taxes, but are they working with advisors that are taking a proactive approach from an early stage? Probably not. So that's, unfortunately, that's one of the things. Like, there are going to be a number of different areas that aren't going to be identified by tax authorities, and I'll just run through my kind of hit list quickly so you can ask the question, that are not going to come up until they're flushed out as part of a process. So, things around IP, things to do with, moving IP offshore. I've seen issues on that on transactions in the past, and that can be hugely costly because it can create dry tax charges, exit charges. R&D tax credits, unfortunately, given the emphasis now from HMRC in that regard, like we've had deals fall over because R&D is not actually R&D, but HMRC have accepted it. But then when we've scrutinized it and looked at it, it didn't meet the criteria. I've mentioned international risks. We see quite a lot of things around, use of EORs, PEs being created or permanent establishments being created internationally, transfer pricing considerations just not being done. I don't think any of those in themselves, depending on the severity of them, are probably not going to be deal breakers. But when you start pulling things together and looking at things in the round, they can make deals fall over. Share options, unfortunately, depending on the size and the scale of how many share options have been granted. If you've messed up an EMI scheme and it's all going to be, you know, subject to income tax operated through payroll, I've seen deals fall over, right? But they you know, they're anomalies. There are ways to fix it.
Just on that was the area the question was in terms of share options, which was more about what are some of the specific issues that you've seen with EMI schemes failing basically at the point of a transaction. Like where are maybe the one or two main areas that kind of we see that happening?
So I'm just casting my mind back to the actual deals that we've worked on. So in order to qualify, you basically you have to be independent. We've had instances in the past where we started to look at the company and it's breached or it doesn't meet the relevant independent criteria by virtue of certain VC holdings, and therefore actually there was never an EMI scheme in place. We've seen instances where the legal documentation has been really poorly drafted, and actually they were never EMIs that were supposedly drafted by the lawyers. We've had issues around valuation, where valuations have not taken into consideration. So you've got valuation agreed with HMRC. However, you know, you might have agreed a valuation, not mention the fact that you've done a fundraise or about to do a fundraise, and therefore, as a result, actually the valuation that you agree with HMRC and the exercise price is absolute nonsense. So again, we've looked at that, and that's been an issue that we've seen in the past. We've seen issues with individuals not being employees of the business and therefore not qualifying. It's mainly down to poorly drafted valuations, poorly drafted legals. Oh, the one that used to catch everyone out was that if you agreed a valuation with HMRC, then had 90 or 120 days in order to then grant your options, and then you needed to notify HMRC within 92 days. This is now passed. If you didn't notify HMRC within 92 days, then it wasn't a qualifying EMI scheme, and that used to catch so many people out. Again, back to my point on automated platforms, because a lot of them didn't actually say, or they didn't have the kind of aftercare support that suggested you need to do that. They're kind of the key areas that spring to mind. Outside of EMIs and share options, I think, yeah, as I said before, IP, R&D, international, considerations around debt, governance, gross payments to NEDs, IR35, and then kind of interesting, you know, every company that we look at always has a different profile. So something always new spins out of it, but any tax planning that's taken into account, we had issues when we had the furlough scheme as well, but hopefully that gives you a flavour.
But the thing, Jake, so isn't it, tax, it's so important that these things come out early, because you've got two options here. You know, you can diligence them to death, but sometimes you can't, or you get the law of diminishing returns. So you can get into, well, I'll tell you what, are we going to think about offering some sort of contractual protections through the SPA, tax indemnities, those sorts of things, and having those discussions early. And again, it will depend on your buyer. Some will be completely, we don't want anything, we want a clean thing with no indemnities, versus others might be more amenable to that. So actually, if you go down that route, you can potentially say, I'll tell you it's a big issue, but we can cut it out just quite simply through something like that.
Yeah, absolutely. And we've seen that quite often in the past. If you can step forward and say, we are aware of an issue, right? And then and you always bring that to the attention of the potential acquirer as part of the diligence, you're in a much better position.
Yeah. Front foot.
Right, guys, we're up on time. Thank you. Covered quite a bit of ground across the space there. If anyone wants to chat with any of us directly, happy to do calls and meetings as required. So give us a shout. Otherwise, thank you. We'll leave it there. See you next time.
Perfect. Thanks, everyone.